BlackRock is the single biggest asset manager in the world. In this video, we are going to review their aggressive portfolio called BlackRock Aggressive Portfolio. So this portfolio is constructed for this robo-advisory platform called Sophie. And this is the portfolio of 11 funds, right? Right off the bat, what you can see is there are a lot of funds here which look like they are diversifying your equity exposure, and with more and more funds with different names, right? You see equity factor rotation, you see US technology ETF, EAFE growth, value, S&P 500. You are now under the impression that this is a solid diversifying portfolio, but it's not the case, and we are going to look at why this is not a very well constructed portfolio. And we will also see and learn more about this concept called factor netting. So we will take a look at the top 3 positions in this aggressive portfolio. 26%, 21%, 12%, right? So S&P 500, S&P 500 growth, and S&P 500 value ETF. What we see in the factor exposure analysis is quite interesting. The S&P 500 growth ETF and the value ETF, they have conflicting factor exposures, especially when you see in value and quality factor exposures, right? So the value exposure, rightfully so, is giving you the value exposure, right? But the growth is opposite of value, so it's giving you a negative exposure. So this is like combining hot water and cold water, right? And the result is you're going to get a lukewarm water. So you're not betting on either one of the strategies to do well, right? The problem with having like factor netting in your portfolio is it sort of gives you the mirage of diversification, or maybe even a satisfaction of complexity. But when it comes to the overall returns, it's not going to move the needle for you, right? And this article is named rightfully, which is complexity is the enemy of investing, right? And the complexity, when it comes from the largest asset manager, it's also like you can't basically basically blame them also, right? Because as investors, we are also expecting, or we love complexity than simplicity, right? We don't want a portfolio with just 3 funds. We want a portfolio with 10 funds or 20 funds to satisfy our complex nature or the complexity expectations when it comes to an investment portfolio. So here, the largest 3 positions just have the factor netting issue, right? The value and growth, they are two opposite. They are in the 2 opposite ends. So you can see the factor netting issues in the first 3 positions, right? We also see the same factor netting issue in other ETFs in this portfolio as well. So as it's pointed out here, the US technology ETF, which has growth oriented characteristics, right? So let's take I'll open this in a new tab. So what you can see here is the growth ETF, which is in the black, and this is like kind of a darker blue, right? So you can see black. So the black and the darker blue kind of similar value exposure, same when it comes to size, also same when it comes to low volatility and quality, right? The exposures are similar. Again, you're kind of replicating the same characteristics, right? When it comes to the US technology ETF, and same when it comes to the iShares Global Energy ETF, which gives you value focus, right? So you can see the energy ETFs is high on value. It's almost close to the beta exposure is close to 1 here, right? So this begs the question that whether you need all this 11 funds in your portfolio, right? And when we compare the performance of the BlackRock aggressive portfolio with a simple S&P 500, right? This is what you get, right? It's basically replicating the S&P 500 ETF, which is not good because you're paying, although no, the portfolio fees is not very high, it's 0.18%, but you also pay a management fee for the company which is issuing this model portfolio, right? Which sums up to about like 0.5 0.6% in expense ratio, when you can simply buy S&P 500, right? And the same kind of confusion, like when you have, let's say, a portfolio of varying funds, how much allocation you give to each one of them, right? Like giving 1 or 2% allocation to something is not going to move the needle, right? So in this portfolio, you're giving an allocation of 2% to this iShares currency hedged MSCI EAFE ETF, which has no, so expense ratio wise is not much, right? It's 0.03%, but having a small allocation is not going to do anything to the overall performance, right? So if you genuinely care about the currency risk, maybe increase the allocation, right? So that's what is mentioned here in this paragraph. And what we are finally doing is, when you have opposing factor exposures, right, like shown in this portfolio, eventually it will just mirror the market, right? So like I mentioned, like an example before, right? It's like combining cold and hot water, so you get the lukewarm water, and lukewarm water is the index, right? So if you're having too many funds, it will eventually mirror the market, and we have seen that in the previous chart. We are also seeing that here, right? When you compare it to MSCI World and again S&P 500, no, we are kind of like mirroring the world as well as the S&P 500 indices, right? So what we have learned in this video is that BlackRock portfolio, which is charging about, the expense ratio is not is nothing, to be honest, right? It's charging about 0.18%. On top of there will be management fees for the company which is issuing this model portfolio to the customers, right? So complexity, the 11 funds, right? There are so many opposing factor exposure, which eventually results in a market based, like basically an S&P 500 or the world index, right, mirrors the market, right? So with more than 10 funds with this complex portfolio, there isn't any extra benefit that you're getting, right? So it's complex for the asset manager who's building this portfolio, and also it's complex for the clients as well, right? But you can't my 2 cents would be, you can't complain, like put all the blame on the person creating this as well, right? Because investors, we as investors also share, as mentioned in the article, share some responsibility, because we prefer complexity over simplicity, right? And don't get me wrong, right? I think BlackRock has delivered like immense value to the world, right? So they have probably in a lot of categories have the lowest fees funds all across globe, right? So they've created immense value for the investors across globe, right? Which I respect that a lot. But also they have to lead by example when it comes to simplifying portfolios as well, right? And only have meaningful allocations in their portfolio. So what you can learn as an Indian investor watching this, or a fund manager, or an advisor, or a mutual fund distributor, or any professional investor in India, what you can learn from this is that be aware of factor netting. Make sure you're analyzing the factor exposures, right? That's why we have built Finominal, to understand the factor exposure, what is driving the returns of the factor, what's driving the returns of all these funds using the factor exposure analysis, right? You can check out our tools as well. But more importantly, we have to be wary of complexity. Making a portfolio more complex might sound interesting at the start, but as someone who's growing their client base, right, it becomes very difficult for you as a manager of these portfolios. It becomes difficult for you to manage this portfolio over long term, but also it becomes more expensive, or the worst case is you tend to replicate the market, right? It is not good for your clients as well. So that's it. That's what I wanted to discuss in this video. Thanks a lot for watching, and I will see you next time with another interesting research. Thank you.